Welcome to FX Tech's comprehensive NZD/USD analysis for November 17th to 22nd, 2025. This week, the New Zealand dollar faced intense pressure, trading near multi-year lows at 0.5613. We'll examine 5 major bearish catalysts that converged to push the Kiwi down, including disappointing economic data from New Zealand, hawkish signals from the Federal Reserve, and a dramatic breakdown in traditional market correlations. Our analysis draws from TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex to provide you with actionable trading insights. We'll cover technical breakdowns, fundamental drivers, and probability-weighted scenarios for both short-term and medium-term outlooks. Whether you're a day trader or position trader, this report will help you navigate the challenging environment facing NZD/USD. Let's dive into the analysis. New Zealand dollar per US dollar is trading at historically depressed levels, currently at 0.5613 as of November 23rd. This week's range was tight, spanning just 85 pips from 0.5607 to 0.5692. The Kiwi was the weakest G10 currency, down 0.80% for the week, 2.21% for the month, and 4.19% year-to-date. What's particularly striking is that we're now only 146 pips above the 2020 pandemic low of 0.5467. Technical indicators show a strong sell signal on both weekly and monthly timeframes. Historically, buying interest has emerged at these extreme levels, but the critical question facing traders now is this time different? The fundamental backdrop suggests caution, as we'll explore in the following slides. The November low at 0.5607 represents critical near-term support that could determine the pair's direction. 5 major news events drove NZD weakness this week. First, New Zealand's Q3 PPI data on November 19th missed expectations badly. Outputs came in at plus 0.6% versus plus 0.7% expected, and inputs at just plus 0.2% versus plus 0.9% expected. This weak inflation data gives the RBNZ no reason to pause its easing cycle. Second, FOMC minutes released November 19th showed the Fed is not convinced. A December cut is viable, causing rapid selling in NZD/USD. Third, AI bubble fears intensified with Nasdaq down 3% for its worst week since April, and Goldman CEO warning of a potential 10 to 20% drawdown. Fourth, NZD/USD stopped responding to traditional drivers like yield spreads and China proxies. Price action now takes precedence. Finally, the longest U.S. government shutdown in history means key data is missing, forcing traders to trade sentiment rather than facts, which favors risk-off and USD strength. Policy divergence between the RBNZ and Federal Reserve is widening dramatically, creating a significant headwind for NZD. New Zealand's economy is showing clear weakness. Q3 unemployment hit 5.3%, the highest since 2016, with flat job growth and a dropping participation rate. Economic conditions are described as lackluster, with growth outlooks that are not comfortable. The RBNZ has already cut its official cash rate to 2.5%, the lower bound of its neutral range. Markets are pricing in a 91% probability of another 25 basis point cut at the November 26th meeting, which would take the OCR to 2.25%. Looking ahead to 2026, further cuts are a coin toss. Meanwhile, the Federal Reserve is shifting from dovish to pause mode. FOMC minutes show they're not convinced about a December cut, with probability now at just 64%. This widening interest rate differential is a structural disadvantage for NZD. 4 confirmed technical breakdown signals are accelerating NZD/USD's downside momentum. First, the pair broke through falling channel support, indicating downside acceleration. Second, a 100% projection target was achieved. measuring the move from 0.6119 to 0.5799 and projecting it from 0.6006 gave us a target of 0.5687, which was hit. Third, we're seeing a clear series of lower highs and lower lows since September, confirming the downtrend. Fourth, both the 50-day and 200-day exponential moving averages have negative slopes, reinforcing bearish bias. Our key technical levels table shows critical resistance at 0.5857, the 200-day EMA, which must break for any trend reversal. Major resistance sits at 0.5800, while immediate resistance is at 0.5692. On the downside, immediate support is at 0.5607, major support at 0.5515, and critical support at the 2020 pandemic low of 0.5467. An unusual and concerning development is the complete breakdown of NZD/USD's correlations with traditional market drivers. Our analysis of 10-day versus 60-day correlations shows Fed rate cut pricing now has weak or no correlation with NZD/USD. New Zealand US yield spreads, historically the strongest driver, are weakening. The relationship with US dollar to Chinese yuan, a China proxy, is non-existent or even opposite of expectations. Copper futures, typically correlated with commodity currencies, show no relationship. Bitcoin correlation has broken down, and the inverse correlation with VIX futures is weakening. As one analyst noted, the Kiwi has been doing its own thing based on these indicators. The trading implication is clear. With traditional drivers absent, price action in NZD/USD takes precedence when evaluating directional risks. This means harder predictions using conventional indicators, increased reliance on technical levels, higher uncertainty and volatility, and price action becoming the primary navigation tool. For the next 1 to 2 weeks, we assign 3 probability-weighted scenarios. Our base case, with 60% probability, is continued weakness targeting the 0.5515 to 0.5607 range. Key resistance is at 0.5692 to 0.5700, with catalysts including the RBNZ cut on November 26th, risk-off sentiment, and weak New Zealand data. The expected outcome is a test and potential break of the November low. Our bull case, at 30% probability, envisions a tactical bounce to 0.5692 to 0.5761, the 50-day EMA. This would require RBNZ being less dovish than expected, risk on sentiment, or shutdown resolution. The outcome would be a temporary rally capped at the 50-day exponential moving average. Our bear case, at just 10% probability, sees accelerated breakdown to 0.5467 to 0.5515, testing the 2020 pandemic low. This would require a 50 basis point RBNZ cut, severe risk-off, or recession fears. Our recommended strategy: sell rallies toward 0.5670 to 0.5692, with stops above 0.5720 and targets at 0.5607, 0.5550, and 0.5515. Looking 1 to 3 months ahead, our base case with 50% probability is range-bound trading between 0.5467 and 0.5800, with a central tendency of 0.5550 to 0.5650. This scenario assumes both RBNZ and Fed pause their policy adjustments and risk sentiment stabilizes. The falling wedge pattern would eventually resolve to the upside, but struggle at 0.5800 resistance. Our bull case, at 25% probability, targets recovery toward 0.5800 to 0.6000, requiring a breakout above 0.5857, the 200-day exponential moving average. Catalysts would include New Zealand data improvement, RBNZ pause, and Fed resuming cuts. Timeline would be late December 2025 or January 2026 at earliest. Our bear case also 25% probability, sees new multi-year lows in the 0.5200 to 0.5467 range after breaking the 2020 pandemic low. This would require New Zealand recession, aggressive RBNZ easing, and Fed turning hawkish. Two key events to watch: RBNZ meeting November 26th and Fed meeting December 10th. Our risk assessment shows the balance heavily tilted toward further downside, with 70% probability. 5 dominant downside risks include RBNZ easing extending into 2026 with multiple cuts possible, New Zealand recession with 5.3% unemployment and flat job growth, Fed hawkish pivot if inflation remains sticky, sustained global risk-off as AI bubble fears intensify, and technical breakdown below 0.5467, triggering stop-loss cascades. Upside risks are limited at just 30% probability. These include RBNZ signaling end of easing cycle, which seems unlikely given weak data, Fed resuming aggressive easing, which would require U.S. data deterioration, China stimulus measures, though correlation is currently broken, falling wedge breakout not expected in ultra-near term, an extreme oversold bounce, which would be tactical, not structural. Our overall risk assessment: 70% further downside, 20% range-bound, 10% sustained upside reversal. The key question remains: is this time different? Historically, buying has emerged at these levels, but current fundamentals suggest caution. In conclusion, our primary trading strategy is to sell rallies towards 0.5670 to 0.5692 resistance, with stop loss above 0.5720 to 0.5770, depending on your risk tolerance. Targets are 0.5607 initially, then 0.5550 to 0.5515. Position size should be 1 to 2% of account per trade. Key levels to monitor on the resistance side: 0.5692 as immediate resistance at the November range high, 0.5800 as major resistance that would signal trend reversal if broken, and 0.5857, the critical 200-day EMA. On the support side, 0.5607 as immediate support at the November low, 0.5515 as major support at a historical bounce level, and 0.5467 as critical support at the 2020 pandemic low. New Zealand dollar to US dollar faces a challenging outlook at multi-year lows with multiple bearish fundamental and technical factors converging. Near-term outlook is bearish, sell rallies. Medium-term outlook is cautiously bearish, range-bound between 0.5467 to 0.5800. The path of least resistance remains firmly downward until 0.5800 resistance breaks. Trade safely and manage your risk.